Hi, I'm Vanessa Thomas.
Hi, I'm Steve Emanuel.
And I'm Connor Donovan.
I'm Tegan Nightingale.
And welcome to Micron.
Now we're going to discuss our intended strategy. The goal was to make our company Andrews a product differentiator and consumer-oriented company. We put a large focus on designing quality products and high awareness and accessibility. We will continue to research and design their products to keep them up to date with both market segment and buying criteria. We started off with one product in the low-tech segment, and then added one to the high-tech segment. Once 3 high-tech products were added, we switched one to the low-tech. This was so the oldest high-tech product would age enough so when we move it, it will be more of an ideal age for the low-tech. Andrew's goals are to have the highest customer survey score, customer awareness, and accessibility as well as profits. Andrews will use marketing tools such as the promo budget and sales budget that will spend to the point of diminishing returns. We will properly forecast demand by using the market growth rate combined with previous year's market share to obtain the best level of production. Through financing abilities, we will take out a lot of debt in stock and bond issues to finance growth, but no short-term debt loans as the high interest rate causes it to be an unattractive investment. Throughout later years, when HR and TQM are available, Andrews will be the first movers in these areas in order to achieve a competitive advantage. It is essential that Andrews accumulates debt in the beginning to enable expansion and competitive advantages against our competitors. But once this has been established, Andrews can buy back shares and bonds, creating a stable long term. The competitive advantage is to offer the best products the fastest, timing our products perfectly with market opportunity, and being the first company to maximize product awareness and accessibility, as well as TQM and HR initiatives.
So as you can see, we actually were the leaders for cumulative profit with a $141 million. Now, we are also the industry leaders in market cap, issuing about 4.9 million shares valued at $72.09. This was part of our equity financing strategy, which allowed us to invest heavily in automation and new product research. So as a result, we did have a lower return on equity and stock price than some of our in-class competitors. However, we did manage to end the game with a 40% market share with an average of 32.48% market share.
Recommendations for a new management team are centered on 3 initiatives. Based on our current analysis of the market, a future management team is well positioned to purchase other small cap competitors within our own market and also the competition within the class, which would make more productive use of our current assets. We currently have $173 million of cash on hand, which will allow future management to initiate hostile takeovers for our 5 competitors within our segment. Should it choose to do so, the team could also purchase majority shares of our main competitor within the class, who also won the simulation, and take advantage of their high ROE and small market cap. To do so would only require $132 million. Our team has accumulated $143 million in retained earnings as well as $173 million in disposable cash. We are well positioned to re-monopolize this market. Employing this strategy would also reduce our working capital by offloading some of our current assets, i.e. accounts receivable, which in turn would allay our equity investors and improve our working capital score. Seeing as this has been the main instrument sustaining our finances, such a decision makes practical sense for our investors. Furthermore, once the new management team purchases their competitors, they can exploit these companies' existing product lines to consolidate control over both market segments to achieve 50% market share, up from our current 40%. Because we were the strongest in customer accessibility, awareness, and survey, it makes sense to purchase companies which offer products that align with this model to mitigate initial marketing investments. Finally, once these initiatives are taken, the new team should employ the same strategies that contributed and sustained our current success, which are oriented around customer survey scores, issuing long-term debt in stock to enhance our leverage, as well as using a conservative forecasting method with our production levels that ensures financial stability from year to year.
The key takeaways of our strategic initiatives were based around 3 elements. First, we tried to move in all areas to gain a competitive advantage through investing early in marketing, total quality of management, and releasing our new products as soon as possible. This early investment in marketing gave us a fast grasp of the overall market share and allowed us to quickly place ourselves as a leading competitor within our industry. Second, we looked to smart forecasting to ensure that we didn't overspend on production, and we kept our inventory low at the beginning of our strategy in order to ensure that we had high levels of asset liquidity. This cash flow allowed us to invest in these various initiatives and further our competitive advantage that we initially moved towards. Finally, we used a smart financing plan mostly based around issuing equity and long-term debt. Our high levels of cash flow allowed us to invest in our company and maintain our competitive advantages without looking to borrow short-term, high-interest loans. Finally, this really allowed us to expand our business by exploiting those competitive advantages in order to lower our variable costs, ultimately allowing us to undercut our competitors in terms of our pricing.